This conference will now be recorded.
Welcome, everyone. Welcome to the Dallas Blockchain Meetup, virtual meetup. And my name is John West. I'm one of the organizers of this meetup. We're sponsored by Thomson Reuters. And I'm the connection there. I used to work for Thomson Reuters. I led their blockchain crypto R&D for a couple of years. Juanelle Mendez, not sure. There she is. She should show her face. Juanelle, turn on your camera. Can you turn on your camera? Say hi.
No, I'm docked right now.
Oh, okay. Well, there she is. She's our TR contact today, and we thank them
Hi,
for their
everyone.
sponsorship.
Welcome.
And so just a quick intro of Michael. He's, like me, a local blockchain crypto consultant in the Dallas area, although I'm independent. Michael has his own company. And he and I have worked together off and on for the last several years, actually also doing projects at Thomson Reuters. We also serve on the Texas Blockchain Council together. We work on conferences together. We talk and get together frequently just to compare notes and figure stuff out. But I have a ton of respect for him. He's really done a lot in the blockchain crypto space for many years. And it's great to have him doing this series, which is actually a series that he's also teaching at UTD. The number of people that have signed up to this meetup has grown. I don't know, it's close. I don't know, it's like 900 or something. But the last 300 or 400 or 500, I'm not sure what the number is because of this series. So there's been a lot of interest and it gets recorded and posted. So with that, I will turn it over to Michael and let him go. And questions. You can we'll start with typing questions in chat, and maybe we'll do verbal questions at the end. It's just when we start verbal questions, then it usually will take a lot of time. So let's start first with just questions in the chat, and then at the end, if we can switch to just kind of a free for all if we have the time. Over to you, Michael.
All right, thank you, John, and as always, thank you for the stellar introduction. I'm always blushing right before we go into this, but that's a good problem to have. All right, so I'll just double check and make sure that everyone is muted, just in case their mics are off. Yep. Okay, so that should do it. All right, so welcome everyone. So this is going to be the third webinar in the series, Rise of Cryptoassets. So what we're going to be doing here is we're going to be doing a deep dive into what do these look like as financial assets, and really what is the financial impact of things like cryptocurrencies and other crypto assets. Because we've talked about money, we've talked about blockchain, now let's talk about like what does this really look like as an entire asset class. So quick disclaimer, since we're going to be talking about potential investments, is always do your own research. And then, just the usual spiel, any investment strategies involve risk. Nothing here should be construed as investment advice. Do your own homework. In general, yeah, you know the drill. So just a quick overview of the series. Last time we did the history, we did how blockchain works. Went a little too far there. And we learned how blockchains can process transactions securely without a third party, and a lot of like the technical features that go into that, like cryptography and mining, and really understanding like why is this technology so transformative? Why is it capable of being decentralized in a way that nothing else before has? And now that we've talked about that, as well as like what it looks like just as money in our first episode, we'll talk about the rise of crypto assets, where we look at like how this is really starting to grow into an entire field of finance that goes far beyond just money, with a lot of potential use cases and a lot of different ways for investors to look for opportunities. So talk about how we're creating new asset classes, but we need to understand how they work. Like, what are the differences between them? What makes them tick? Why would I purchase, let's say, Litecoin over Bitcoin or Ethereum over Bitcoin? Would I purchase both? Would I want to have more Bitcoin than Litecoin? Like, these are all questions that people sometimes talk about in terms of like what their trading strategies are, but there's really not a good fundamental understanding of why you would do one strategy over another, other than potentially trial and error, which is very costly and is not something a lot of typical investors are really have the time or money for. We're just looking. You might be just looking to see, where would I start? What are good strategies? How does it line up with an existing investment strategy I might have? These are all things that we'll be covering. We'll cover the different types of crypto assets, the possible ways to value them, and then the impact it has on future portfolios. Like, why does a portfolio in the 21st century need to be considering crypto assets as something to potentially have in it, even if it's at a small allocation? So to truly understand what that financial impact is, we're going to, as usual, go back to kind of the beginning and think more about like, what are traditional assets, and then how does that apply to a crypto asset? So let's go over asset classes. And if you're a financial professional, I'm sure this is going to be a review, but for some of you that are maybe new with some of these terms, it should help you set the baseline. So an asset class is just a set of assets that bear some shared attributes or characteristics that make them unique. You expect everything within an asset class to kind of behave the same way, or to have the same specific features in terms of the way it's valued, the way it appreciates, the way that you might hold it. These are all things that should be very similar among an asset class. And they're very useful for categorizing the different investments you might have in your portfolio. So you might actually have an interesting mix of asset classes within your portfolio to get a good market return. So examples would be, of course, equities, which are stocks and other collective ownership claims for a company. You could have fixed income, which are basically bonds. So instead of appreciating, which is typically what you see of stock outside of dividends, fixed income is typically focusing on like giving you a set rate of return over time, which is backed by some securitized debt. So either a corporate, government, or sometimes individual assets typically. But bonds are typically, as an investment, they're typically something you would see from large corporations or governments and possibly municipalities. And then cash, of course. Cash is any fiat currency that you can hold, typically used to purchase equities or fixed income, or how they appreciate if you get a payment over time. So it can apply to your money market account, it can apply to your savings account, a CDI potentially, as well as just foreign exchange trading. So these are kind of like the three main assets that you would see in any portfolio. There's going to be a mix of all three in most portfolios, from a traditional investor to a hedge fund. They typically will have all three of these, or at the very least, two of them. And one thing that you see, because they make such a big part of the market, is that these are actually correlated, which means that if one exhibits a certain behavior, or the market moves against it in some way, you might see that impact other asset classes. So an example is stocks and bonds, which are typically inversely correlated with one another. So when the price of a stocks as a whole fall, there might be a rise in bond values as people go into what they might see as a safer investment when stocks are doing poorly. And you can see this relationship over time. If you compare a bond index to the S&P 500, you can see that whenever there's a big uptick in the bond prices, there's typically a downturn in stocks, and then vice versa. And so that can be good if you're trying to hedge your bets in a market. It's good to know if you hold some stocks and bonds and one goes down, the other will probably go up to compensate for any losses. However, this doesn't always hold true. Sometimes you have issues where the whole market is going down. Let's say that cash is being depreciated, or there's an inflationary event, or just the overall financial system is running into issues. Something that's backing the bonds is also impacting the market. So there are times, such as in the 2008 financial crisis, where all the asset classes are actually falling, and that can impact your portfolio negatively. So that correlation doesn't hold up. And if anything, the correlation is now a problem, because the correlation means that the whole market is going down, and so will your portfolio, regardless of if you have different asset classes. So this is something that a lot of portfolio managers have been looking at, and there's a different class of assets that they consider as a way to hedge against this, and that would be alternative assets. Alternative assets are things that typically don't fall into those categories, like stocks, bonds, and cash. What you would typically see in alternative assets is a way to get around the typical correlation with the market. So you can see this is a gathering of different alternative investments, and you can see that during the market crash of 2008, some of them did not go down nearly as far as the S&P 500, and in some cases their recovery was actually far better. Some of them didn't recover as well either, but the idea is that you want an alternative asset not necessarily because it's going to do better than the market, but because it will be different than the market. And if the market goes down, your alternative asset might either go down less or potentially go up, depending on what kind of asset it is. So here are some potential examples. Precious metals and commodities are a very famous one. Gold's doing very well right now at $2,000 an ounce, so it's considered a safe haven during market uncertainty. You also have real estate, which is a kind of a fixed income asset that is kind of it's a hard asset. It's something where there's ownership. There's always someone that wants to rent it. There's land, so it's considered something that's a little bit more, physical than something like a bond or a stock. You have venture capital. Sometimes people will deploy venture capital rather than putting it to the market to try and get better returns, especially in a very small, a low interest rate environment where people are really starving for returns. And then even just collectibles, art, antiques. Sometimes people will invest in Rolexes, and if they appreciate over time, or if they're considered valuable assets to the point where you're potentially writing off taxes on appreciation for them, then in terms of they're contributing to your net worth, I would say is if it's large enough to contribute to your net worth in a meaningful way, then it's typical. Then even something as simple as a collectible can be considered an alternative asset. You could even consider ammo, whiskey, anything you want to store for the apocalypse is an alternative asset. Might not be the best thing to put all of your money into, but this is like the idea is that these are things that you typically don't see in a portfolio, but they give you they help you manage your risk because they give you something to rely on in uncertain markets where the rest of the asset classes are doing poorly. But most importantly, crypto assets would also be considered an alternative asset, which is why we're discussing them today. Cryptocurrencies and other crypto assets are becoming especially popular as a portfolio hedge that protects against large market sell-offs and provides uncorrelated returns. And I'll add a caveat here and say correlations aren't always, it's not always uncorrelated in terms of sometimes the market will impact cryptocurrency or others. We've seen this sometimes in the last year or two in terms of sometimes the market, crypto markets will respond to market movements, but typically what you see is that the movements are not as strongly correlated, and in sometimes cryptocurrencies can do well in spite of the market, or other crypto alternative assets can. So it's considered a way to provide uncorrelated returns and really improve your portfolio's diversification. So let's consider what crypto assets are. Let's look at some definitions. So a crypto asset is typically anything that represents value or some contractual right that you have that's also secured and traded on a blockchain or DLT. So basically, cryptocurrencies are obviously a good application of that, but it can technically be any asset as long as it is traded on a blockchain where the transactions, the ways that you move the asset around, are stored on the ledger and verified in that way. So you can really expand your scope in terms of what could be considered an asset as long as you're able to put it onto a blockchain. So as we've learned before, that cryptography makes these crypto assets very trustworthy, and it doesn't require intermediaries for the network to function, which is very unique. Crypto assets are unique among other assets because they can support large global marketplaces without relying solely on financial institutions, which further reduces their risk profile. If you consider the fact of how 2008 impacted the other markets, a lot of it was because the financial sector was hit the hardest, and the financial sector was such a key part of other asset classes and economies that even though companies that didn't seem to have anything to do with the financial sector, such as GE and others, or rather specifically the real estate market, AIG and others, like they were all exposed, or at least the financial assets behind them were exposed because of the correlations between them, or the very complicated relationships that existed. Whereas crypto assets, even if a big exchange went down or something happened in the market in terms of a big player was taken out or did something wrong, it would impact our markets. It wouldn't be perfect, but crypto assets have the ability to, someone could stand up a new exchange the next day. At least technically, there might be regulatory issues with that, and we'll actually get more into what the regulatory issues are today. But really what is unique about crypto assets is that they can function solely on their own in terms of being able to exchange and create markets that are decentralized. You still have big players, you still have big exchanges, and they still play a big part, but they're not as essential as they are when it comes to trading stocks and bonds. If we didn't have a brokerage or these online exchanges for Fidelity or for stocks and bonds, we would just have paper, and I don't have a good way to trade paper stock certificates with someone who's across the world, but I could do that with any crypto asset. So consequently, because there's not this big limitation on financial institutions being there to make a market happen, markets can happen without them, and then typically they come in after. Crypto assets as a marketplace have grown to upwards of 850 billion in 2018, and I'm sure there's a better number for it today, but I figured I'd go with that because it'll change every week. But crypto assets themselves do have challenges. There are still some issues despite all this potential, and it's specifically in how you categorize crypto assets, especially in relation to normal assets, which have really posed a challenge for adoption because it's difficult for investors to understand them and it's difficult for regulators to categorize them. So let's get a little bit into that. Like, how do we define crypto assets? This is where we can get into what some experts that wrote the crypto asset book have called the taxonomy of crypto assets. How do you classify them? So the first thing we can look at is what are the legal definitions that we see here in the States. Several federal agencies have issued some ruling or some regulatory guidance on how virtual currencies and in fact many crypto assets need to be categorized, and it's resulted in it's got some very different results. Like, it's very difficult to see the federal agencies and figure out exactly what a crypto asset is because they have very different definitions. So we can look at those real quick. The CTFC, Commodity Futures Exchange Commission, they consider Bitcoin a commodity for regulating Bitcoin exchanges as well as futures contracts, which is definitely different than the Financial Crimes Enforcement Network and the DOJ, which they consider it money for the purposes of money laundering. So FinCEN requires you to have a money services business license if you're going to do virtual currency trading, which you wouldn't necessarily need if you were just trading a commodity like corn or coffee. So obviously they're right there. There's obviously some weird overlap. DOJ is the same way. They pursue money laundering cases with virtual currency. The SEC more recently has gotten involved ever since the ICO craze. So it's been applying the Howey test to see are some of these initial coin offerings securities versus money or commodities. And then RRS comes in and says, with kind of a blanket statement, that any virtual currency is property, and therefore you need to report everything around it as capital gains, which doesn't necessarily conflict with these other definitions. But the problem is that as a virtual currency with the IRS, they basically say that, let's take an example actually. The peso, if I go and spend pesos in Mexico, I don't have to, or I convert peso to dollar, I don't have to pay a capital gains fee just because I'm purchasing something with pesos, and I need to like subtract the dollar value of when I originally purchased it and something like that. There's a cap for those sorts of things at like $5,000 or $10,000. So you don't have to do all these sorts of things. You don't have to pull up your calculator every time you buy something in a foreign country. This does not currently apply to cryptocurrencies or virtual currencies, which has made it very difficult for businesses sometimes to accept them, or just for an individual to be compliant while using it as just a normal payment method. There are bills in Congress that are going to try and change that and treat them more like foreign currencies, but we will have to see how that plays out. But the point is, there's obviously a lot of confusion. It's very difficult from a business and investment perspective to understand what these crypto assets are. How do we treat them? So we obviously need a very different way to break these down. And there's a good list of definitions that the crypto asset book can give us. So one is the traditional one, cryptocurrencies. Cryptocurrencies are anything that is really trying to be a digital cash. It's not trying to necessarily do anything more. It might have some additional features that help complement it, but for the most part, it's trying to be a currency that is a medium of exchange, a unit of account, and most importantly, a store of value. That's what a lot of cryptocurrencies are going for. And so you typically see them focused on use cases for online payments, sometimes in person, and anything around that, anything to make payments more accessible. And so that would definitely be Bitcoin. It was the first. We talked a lot about that in the first episode as far as how it was considered a new form of money. And then many subsequent altcoins that have come after it are also doing the same thing. Now, around 2015, 2016, new uses for cryptocurrencies were being explored, and this really introduced a new classification that is being called crypto commodities. And these were going further than just saying you can use this coin for payments. You can also use it to purchase digital resources. And basically, if you're thinking about commodities are typically something that is in bulk and very and widely used in an economy. Coffee, oil, gold, silver, natural gas, like anything that can be done and traded around in bulk is typically a commodity. And so when we look at digital resources like compute power, storage, and bandwidth, they actually seem very similar to a commodity. There's just not like a unit of compute power or storage or bandwidth that we typically associate with it, because that's typically some piece of hardware sitting sometimes. But as hardware itself is becoming commoditized, you can start to actually commoditize. You can actually turn this into a commodity asset class using things like Ethereum and other platforms that basically provide trusted computation and other resources that would be needed to run a decentralized application. You need compute power, storage, and bandwidth for any application, but if you want it to be decentralized, then it's even better to use that on a blockchain. And then last of all, which are probably the most recent, the most known because of ICOs, are crypto tokens, which are used for digital goods and services. So a crypto commodity would be like a raw resource that isn't necessarily something for a consumer, but something that a developer or a company might use. Whereas a crypto token is something that a consumer or like a SaaS product would look like. It's like you're paying for some good or service that's pretty much ready to go. And they're kind of like, you could call them gift cards, reward points. Sometimes they have other features behind them, but they've also been called utility tokens because there's some utility behind it. And these have typically been used to fund blockchain projects by pre-selling tokens for that service. So if someone wants to build a platform for some use case and they want to get the funding ahead of time, and so they'll sell a token and say, hey, if you purchase this token, you can use it to purchase the resource or the service that I'm offering you once we have it built. And typically the idea is if the utility of that token is valuable, if people want that utility, then the price of the token itself will appreciate, or at least that is the idea. And so many ICOs and coins have been specifically used for this sort of thing. Even Ethereum was an ICO, but it's an interesting overlap because it's considered more of a commodity because it goes to a resource. So I would say these are all good definitions, and typically one project will fall into one category more than the others, but there can still be a bit of overlap. You could even say that Bitcoin is a crypto commodity because you use it to purchase, you use it to pay fees to send Bitcoins as well. So there's definitely a little bit of overlap and mixing that occurs. Yeah, and Tom and Lindsay is talking about how, so Microsoft Azure is creating their own tokens for rewarding employees and customers. So there's a lot of interesting use cases for tokens in terms of what the economic incentives and financial structures can look like. So let's look at some examples. So along with Bitcoin, we have a lot of cryptocurrencies trying to be that alternative to cash and centralized payment systems. Bitcoin is obviously the famous one. We've talked about it a lot already. Most significantly, it was the first. Transaction time is 10 minutes, and there was a total supply of 21 million. No more than 21 million Bitcoins will ever be created, which gives it a bit of scarcity. What came after Bitcoin as kind of a famous alternative was Litecoin, created in 2011, and it provides a little bit of a faster transaction time and a larger supply. 4 times the supply actually. And so this is because of these specific properties in terms of it's technically a little easier to transact and there's more of it. It's actually been compared to kind of the silver to gold relationship. So it's been called the silver to Bitcoin's gold. And that's a good way to think about it in terms of an investment, potentially as an investment. And then the other one is Ripple. So Ripple is an interesting one where it was created actually as a potential payment network. There was actually work going on Ripple before Bitcoin and blockchain became big, and then after Bitcoin kind of validated it, the Ripple team ended up deciding to create a cryptocurrency protocol as well. It has a very instantaneous transaction time because of the way it's been structured to service through different payment gateways. And most suspiciously, it has a very large supply that was originally issued by the company, and there's no mining or proof of work that really like protects the supply from growing more rapidly. It's actually entirely up to the discretion of the Ripple team. So for this reason, it's been kind of considered not a true crypto. It's kind of a pseudo crypto because it doesn't necessarily have all the decentralized and the same it's basically the lack of decentralization that causes a lot of people to pause with Ripple, but it does have a lot of business impact with banks that have been trying to use it. And then one last example is Monero, which is one of many privacy coins out there. The whole point is to provide more privacy features because with a typical blockchain, you can actually see where a transaction is going. But with Monero, as well as Zcash and Dash and others, it hides that transaction so that you can't actually see where it's going to. And so this has made it very good for people that want privacy, but also in some cases darknet markets that are trying to stay away from federal authorities. So it's an interesting mixed bag, but it is a very it's a part of the community that is very active in terms of creating more privacy coins, especially for Monero and others. And so now let's go into crypto commodities. These are going beyond just payments. You can use them for payments. It doesn't necessarily mean it's not a currency, but as a commodity, it might be, if you're trying to value something like Ethereum, you might be looking at it more as a commodity in terms of what is the value to get the resource versus what is the value of sending payments. So Ethereum is one of the first. It has a currency called Ether that was created in 2015, and its whole idea is that you can pay compute fees to run smart contracts. Like we said before, consensus is proof of work moving to proof of stake. But the real reason to know Ethereum is because it was the first and it is still the biggest. It's the second largest in market cap, and it's got probably the biggest developer community in terms of creating smart contract platforms. And it's even gotten traction with permission blockchains and corporate projects. The next one that kind of came after Ethereum in terms of like trying to be different was EOS. So EOS was created in 2018. It had a big ICO as well, raised a lot of money, and its whole thing was it was trying to increase scale and reduce fees compared to Ethereum. And so one of the differences is that instead of paying for computational fees, like you pay for whatever amount of computation you use on Ethereum, with EOS, you will actually use it to lease bandwidth. So you would put a token down to lease bandwidth, and the idea would be you'd have to pay a lot less fees over time. It also scales faster potentially with delegated proof of stake, which means that people will delegate their stake to a group of 21 nodes that act as block producers. And this increases scale, but it does also reduce security. And EOS has been kind of controversial because of some of the security issues and governance issues that it's had as a protocol. But it is still a large market cap and it's still active in the cryptocurrency community. RSK is another very interesting one. The whole idea is it is bringing smart contracts, including Ethereum smart contracts, to Bitcoin. So what it does is it's actually building smart contracts on top of Bitcoin and plugging into the protocol. And so the consensus is actually a merge of both proof of work on RSK and proof of work on Bitcoin, with the idea of making the entire thing more secure than something like Ethereum, because it's using both the Bitcoin proof of work as well as its own. And the whole idea is you can also tap into the Bitcoin ecosystem and move Bitcoin around with smart contracts. So it's got a lot of interesting ideas behind it. And then last but not least is Cardano. It is another project that is actually focusing on changing the way that smart contracts are built, or more specifically, blockchain protocols in general. It was started by one of the original Ethereum founders, Charles Hoskinson, and the idea is that you are actually going to build it around peer-reviewed research. So instead of a group of developers kind of, probably coordinating with the community, working together, but maybe not reaching out to a lot of different institutions to validate their ideas. This is built around the idea of engaging experts, even outside of the blockchain community, to assess security, economic feasibility, and a lot of other ideas. So it's a bit of a slower moving protocol in terms of how much development gets done, but it is considered to be much more thorough in its process. And it too has its own cryptocurrency that you pay, you basically pay compute fees for. And it has a consensus algorithm that's kind of unique, but essentially uses a form of proof of stake. Ouroboros, I think is how you say it. And then last but not least, crypto tokens. So these are tokens that are used to pay for services, and they often run on existing blockchains like Ethereum and others. So usually a crypto token isn't trying to be its own protocol. It might run on Ethereum or another that allows you to create your own tokens. This isn't true for every crypto token, but I would say most of them are not trying to be their own blockchain. They're just trying to build a specific service on a blockchain. So a few examples. One of the biggest is Binance Coin. It was an ICO launched in 2017 by one of the bigger exchanges, and the whole use case was that you could essentially pay for your exchange fees in Binance Coin, and it would be cheaper than paying it in like another cryptocurrency. So they would incentivize people to use this token over others. So it's still one of the largest crypto exchanges, and it's kind of expanding use for its coin in other realms, where it's like you can redeem it for reward points with their partners as well. So it's an interesting idea of how to, because the platform itself is not decentralized, at least not yet, in terms of the exchange itself. But they're trying to move in that direction with Binance Coin as kind of like a base for it. Another one is Chainlink. That's become very popular in the last year or two. Its whole idea is that it provides trusted data feeds to other dApps. So the idea is that if you are trying to figure out what the temperature is today, let's say you have a smart contract that's betting on the temperature, how do you learn that temperature? Who's going to tell you outside of the blockchain? It's not like the blockchain has a temperature reading on it. So the idea is that someone could provide an oracle that provides that information. But if it's only coming from one source, then the smart contract isn't really decentralized. It's relying on a single person to provide an answer. So the whole idea of Chainlink is that it creates a decentralized, or at least a trustable data stream to a blockchain. So you can figure out what's going on in the outside world. And its usage is for, the coin is used for paying fees to get these data requests through an API. Another very famous example is Filecoin, which is trying to build a peer-to-peer file storage system. The idea being that you could use Filecoin to pay someone to store a video on your computer or other computers, with the idea that it would be like Google Drive or Dropbox, but you wouldn't be trusting a single company. It would be stored on multiple servers with redundancy, and you would be compensating people directly to use that hardware. It was almost infamous because of the amount of money they raised. They raised almost 200 million within 30 minutes. And while the protocol is continuing to work, they're continuing work on the project. Some people have definitely questioned whether that was the best use of funds or if the ICO was structured properly. That was really during the height of the ICO in 2017. And then one last example that I do like is BAT, which is Basic Attention Token. It's a token that was launched for advertising platforms, with the idea that instead of embedding ads in websites and basically compensating websites that way, you would actually have users go to a website and opt in to see advertisements, and then they would be compensated directly using this basic attention token. So someone who wanted to advertise would put in a lot of basic attention tokens, and they would be solely paid out to users that were seeing it. And they've actually partnered with the Brave internet browser as a way to launch that platform. So they actually have something that isn't just relying on cryptocurrency. It's an existing kind of privacy-focused internet browser started by some of the original people that built Mozilla. So very interesting project to watch as well. And all of these, I would say the valuations are very difficult to get down. Some of them we're still seeing in terms of like how valuable is the token, but I think crypto tokens as a model aren't going away. It's just going to be a big question on how valuable it is for the protocol long term. It's good for getting the initial fundraising, but will it translate into future value for the token holder? We still need to see, and it might depend on the project and the success that they run into. Devin Ellis is asking, I've also heard of smart contracts trying to be used in programmatic ad buys instead of running through something like DoubleClick. Is this what they would be using? Probably, yes, I have heard of that. I think that is a milestone for the Brave team, but they have not yet implemented that. But the idea is that eventually you would have trusted ad execution. And there's actually a local company here in, or there's a company working with Hedera that is actually doing transaction tracking called they're called AdX, and they're basically tracking and verifying that people are watching ads. And I think their goal is also to make ad buys programmatic as well. So that's a use case people have been discussed. I don't know if there's a working example of it, but it's definitely something that are in people's minds and potential roadmaps. All right, so we've got a pretty good definition as far as like what's out there. So now let's get into what does investing look like? If you wanted to invest in crypto assets, how would you potentially go about it? What do you have to be careful about? Because again, this is not about investment guidance, but this is more of like, where would you go to get started in terms of learning how to invest? I'm not going to teach you how to invest in this talk. I'm just here to make you aware of like what the challenges are for any investor. So first of all, you need to know the risks. What are the risks of owning crypto assets, and what are unique about them versus other asset classes that might seem easier by comparison, like stocks, bonds, and cash? So one thing to be aware of is that just because they have immense potential doesn't mean that they aren't without risk. I think crypto assets themselves are always going to be here. I think they're going to be very successful for years to come. But knowing which crypto asset to invest in to make sure that it's not something that's going to be subjected to a regulatory crackdown or is part of a fraud, that's something that you need to be aware of when you're going into the space. That's one of the reasons that you need to have a lot of due diligence. So one famous example of that is BitConnect. It was a cryptocurrency that was tied to a Ponzi scheme program, valued almost at $2.6 billion. And what was like really insidious about these projects, because there was a lot of them, it wasn't just BitConnect. And I've seen people here in the Dallas-Fort Worth area get into these schemes and ask me for help on buying crypto and other things like that. And it got to that point where I had to tell them, I can't tell you for sure this is a scheme, but I'm pretty sure it's a scheme, and you have to be very careful about what you're putting money into. And what was insidious about them is what they would do is they would let you would pay in, like let's say you throw 1 Bitcoin into this project, and it would pay you that Bitcoin back over time. Usually they would say it's we have a special trading algorithm that will, if you give us the money, we'll pay you back the returns over 90 days. And you would get double your money back over 90 days. And it would pay you to your cryptocurrency wallet every day, a small portion of that. And what was insidious is that people saw that. If people understood how a cryptocurrency transaction works and the fact that, if it's in your wallet, you own it, it's not going anywhere, they would think, oh, this must be legit because they're paying me out daily. I'm getting the money back. I control it. And the problem was, yes, they were doing that, but they were only doing that as long as more people were putting money in than were taking it out. And as soon as every Ponzi scheme in the space was the same. As soon as they hit the crux of getting as many people as possible, had this whole multi-level marketing scheme of you earn money from the people that you bring in. But once it hits peak, it was downhill from there, because immediately the guys, whoever was running it, they would shut it down. They would disappear off the face of the map, typically taking a large number of funds with them. And it was kind of a tragedy, because a lot of people that were just trying to get into cryptocurrency investing were getting snapped up by these scams that were kind of specifically targeting them, knowing they were new. And it was really sad, because I think there's a lot of potential for people to own cryptocurrency and crypto assets, but this is the reason that it's not something you should do casually, because of these sorts of schemes that are trying to take advantage. And they're still out there. There's less of them. They're less obvious, I would say, but they're still out there. So when you consider that as an alternative investment, you should also consider this as a small allocation, especially if you're a traditional, you're someone who's trying to save for retirement, or you don't have a lot of money to begin with. Just keep that risk profile small. As far as what that looks like, talk to your investment advisor or whoever else you would trust for that sort of advice. But in general, it should be a very small minority of your portfolio, the same way you would put a little bit into gold or silver. And so before you purchase a crypto asset, you also need to understand who will be holding custody. And by custody, I mean who holds the private keys, because that's ultimately who has the ability to move it around and send it other places. And so you need to make sure that either you have sole control of the private keys, or whoever does is someone that is worth trusting. You also need to consider, like, what's your valuation method? How are you looking at these assets? Don't get caught up in the hype of they're going to change the world. How are they going to change the world? What is the specific impact they will have? Why are they going to change the world more than another crypto asset or another project might? That's something you really have to dive into. And then most importantly, is the platform legitimate or potentially a scam? You really have to do your due diligence there. They'll try to make it appear legitimate, but if you don't see the right signs in terms of people providing transparency or making themselves known, having real business entities around it, even if it's like a nonprofit foundation, like that, if there's not a clear indication of who's involved, that can be a big red flag. And then most importantly, know what the legal due diligence is. What are your tax obligations, and what, are you regulatory compliant? Especially if you're trying to do a lot of trading or do a lot of crypto movements, you might have, you might be subject to regulatory compliance. Talk to your lawyers about the details on that. So let's get a little bit more into custody options, because this is one thing that you as an individual can do on your own as long as you have a good understanding of what you're doing. So the first thing, the first option I would recommend to anyone that is potentially getting into the space for the first time is to use a cold wallet. And these are wallets that are entirely disconnected from the internet. And the reason that's important is that if you don't have a network device, then there's no way for someone to steal your crypto without having physical access to it. So it's very important that if you're trying to store a large amount of crypto, you keep it disconnected from the internet, if at all possible. It's considered the most secure way to secure these assets, and you can do it with a hardware wallet, which typically run around $100. But if you don't want to go that far, you could even print out a private key and essentially have a paper wallet, which you keep somewhere secret, like a safe. So it's I would say it's very accessible. You can either go the fancy route of having a crypto wallet or a hardware wallet, which is, I would say, easier to manage multiple funds on, or you could just have paper wallets. If you're not expecting to touch them for a long time, if this is a long-term investment for you, then this is a good opportunity. This is a good method to use, because it's similar to putting gold, burying gold under the house or putting it in a safety deposit box. You could even put these in a safety deposit box if you wanted to. So I would say this is a very good accessible option. Tommy Lindsay is sending out an interesting question, or statement. So 2 risks are Ledger wallet hack. Now hackers know physical addresses of wallet owners may not be a big risk, but one needs to devise a way to hide/secure that wallet. Yes, so that is an issue. Hackers know physical addresses of wallet owners. So that might be a hack I'm unfamiliar with, but I would say even then, the thing with a cold storage wallet is that if it's not connected to the internet, you're not at risk. When you connect it to the internet, there is some risk, and there are some hacks that occur to get to a cold storage wallet.
Well, I guess what I'm saying by that, Michael, is that when they hacked the Ledger database, they didn't get private keys, but they got the physical they got the email addresses, and they got the physical addresses of all the wallet owners. So now someone could say, "Oh, I see, Tommy owns a wallet." They don't know how much is in it or what you got, but they may say, "I've got your address. I may just go check in and see what I've got there." So that's why I said it's a secure way of doing that. So.
Okay, gotcha. Yeah, and that makes sense. It's because that's more of a So the physical risk is there. I see what you're saying.
Yeah.
So yeah, if for any of you that would be hesitant to engage with a company like Ledger that might have those issues, it would be good to then just go with a paper wallet option potentially, because there's software online that will generate paper wallets for you very easily. If I were you, I would download the software on your computer, unplug your computer from the internet, or even maybe do it on a disconnected device entirely, and then maybe print that out. There's ways to do it super securely that I won't get into here. In terms of, there's never a chance for that private key to have been touched by the internet or uploaded later. But I would say overall, most of those methods will be good enough. But if you're storing large amounts of money, I would say put more effort into making sure that you're protected and keeping secure. And then let's see. And yeah, it's actually number 2 is a great point in terms of next of kin. I've had to work with clients on devising and writing down instructions for how to get a loved one's cryptocurrency or other funds should they die. So that actually, I've cooperated with lawyers that are basically trying to put that into wills with the proper instructions there. And so that's another difficult part. And so for cold wallets, I would say if you're storing enough that it's like a large part of your net worth, having some sort of information or instructions on how your next of kin could get access to that is going to be really important, especially if you want to be able to pass that on in any circumstance. And so after cold wallets, you get into something that are called hot wallets. And really the only significant difference is that hot wallets are traditionally connected to the internet or connected regularly. And so they're still aiming to keep your private key secure, and they'll take every security precaution they can. But you do have to know, even though it's more convenient, because you can send and receive cryptocurrency pretty easily, you don't have to, pull it out of a safe or plug it into a computer or, type out a private key. It is potentially more accessible to hackers, and there can definitely be cryptocurrency hacks, either from your device being hacked or from some bug in the wallet software itself that can cause a large scale hack. And that's one thing you always have to be aware of. And so the mentality I always have with a hot wallet is that it's like a cash wallet you carry around. Only carry around what you would be willing to lose in a situation where you lost your wallet or something like that. And if you do have a hot wallet, always create backups, because sometimes I've seen people that they'll use something on their phone. That's where a lot of hot wallets are. It's where mine is. And what they'll do is they'll get a new phone, and a lot of people have gotten used to the way that phones will just migrate your data over. And when the private key doesn't get migrated over, they're kind of stuck wondering what happened, and they might have already wiped their old phone, and then they're out of luck. Or, and your phone can drop into a river. You have no idea. And even if it's a smaller amount of money, there's no reason to lose that if there's a way to recover it with a backup. So I would say always create backups of any wallet where you plan to store a significant amount of money, or will ever store significant amounts of money. It's always good to be proactive and get that done in the beginning, and then put it somewhere safe. And then the last ones I'll talk about are probably the best for the serious investor, which is a third-party custodian. And these are providers of secure storage for cryptocurrency. These can be exchanges, but they can also be other wallets that are more focused on just having third-party storage. And this is where the cryptocurrency is held in trust for the user. So you're essentially trusting this provider to give you the cryptocurrency when you want it, or just to hold it like a normal brokerage would hold stocks or bonds. They might not have a specific cryptocurrency with your name on it, and depending on the service, some of them might. But most of the time, the idea is that you can always trust them to give it out because they have a lot of good, regulatory compliance, or they have a lot of industry standing. Coinbase is kind of the famous one here in the US for both retail and professionals. But Binance, Gemini, and then some custodial services all exist for anyone that is really trying to get like large custodians, especially for institutional investors. So these custodians, they offer you both convenience and, I would say, a high level of security, at least today. But they do introduce third-party risk, because you are trusting this third party. You're trusting them not only to keep those cryptocurrencies secure, but you're also trusting that there will not be a regulatory crackdown, that you'll always have access to those funds. These are becoming more of a financial institution, so you do run more financial risk. The same kind of risk you might run with holding a stock or a bond in a brokerage, and it might be acceptable. And in a lot of cases, it would be, especially if you need quick access to market liquidity, or you're operating a fund where you don't want to take the risk of putting all of your investors' money on a cold storage wallet. That doesn't make sense to you. Using a third-party custodian makes sense for a lot of people, but it's just something where you need to be aware of the potential risks and potentially have a plan where if something weird is going on with your third-party custodian, have an exit plan. Be ready to move to a cold storage wallet or another third-party custodian if something is looking fishy. This is what happened with a lot of people on Mt. Gox back in 2013, because Mt. Gox was one of the first biggest Bitcoin exchanges that got hacked, and they lost billions of dollars of investor money, and a lot of people were totally out of luck. But over the months before this occurred, there were definitely signs that something was going on, and smaller hacks that had occurred. And so a lot of people, including myself, and I honestly just got lucky here, ended up moving our money out into other areas because we saw kind of the writing on the wall in terms of there's something going on here. We don't know what it is, but we don't like it, and we knew the risk of these private keys are held by them, and if they lose them or if they lose access, then it's our money on the line. And sure enough, a lot of Mt. Gox went down, a lot of people lost money, and that's a good example of a third-party risk that you should always be watching for and avoiding. And I would say like Coinbase and others, very, very reputable. They've had very small hacks since, but typically they actually hold a lot of their funds in their own cold storage wallets to make sure that a hack is very difficult to at least get away with a lot of funds. And you even get additional protections with Coinbase, because for those of you that remember the Twitter hack, that occurred a week or two ago, where people were sending Bitcoin to all of these different people that had been hacked by this one 17-year-old kid, apparently. He was actually not very sophisticated, because he used one wallet address for all of these different accounts that he was doing tweets for. And so Coinbase and other exchanges actually blacklisted that as soon as they saw it, to prevent customers from sending their money to it. And so they probably saved their customers quite a bit of money. Which is an advantage if that's what you're concerned about in terms of consumer protection. The flip side of that is, of course, well, maybe Coinbase doesn't let you send money to where you do want to send it. Again, third-party risk, it comes with a lot of advantages, but just be aware it's kind of a going back. It's solving a lot of blockchain problems by going back to a more traditional way of managing funds. And so Tommy's asking, companies like Celsius and BlockFi, you get interest on your crypto, not your keys, not your coins. Yep. So that's a similar thing where, yeah, you're going to earn interest on your cryptocurrency, and it's very similar to putting money in a bank. It's essentially a bank for cryptocurrency at that point. Because just like a bank, you would earn money on a savings account. But yes, it is where you are trusting that third party with your currencies, and unless they're FDIC insured, which I doubt. I don't think that's a very common thing for most blockchain accounts. I've heard of a few cases, but I doubt it in Celsius and BlockFi's case. Yeah, you are running the risk that if that company or that organization goes bankrupt or has some sort of catastrophe, your funds could be at risk. So that's always something to be aware of. Yeah, not your keys, not your coins. In terms of like you don't control your coins in the way a blockchain, to the greatest degree a blockchain can give you, if you don't have your private keys. So that's custody. Very important for anyone trying to get into this industry. I would always think about your custody methods. And I'll run through these valuation methods real quick, because these are like ways to think about a protocol. And we can talk more about them in the Q&A, but I'm not giving you too much detail here, just kind of running through a quick list. So one valuation method is the white paper. That's typically a good starting point. It's kind of like what are they really trying to prove? What is the use case? Is it realistic? Does it make sense? And typically what you would see, especially during the ICO craze, is you would either see a realistic solution. These people know what they're talking about, or you're seeing an empty sales pitch. There's a lot of white papers that read like, okay, they don't know the technology like they should, or they're just not really focused on that. They seem to just be wanting to sell something, which is not a good sign. Excuse me. You also have the cost of production. How much does it cost to produce new coins? So in the case of Bitcoin, this is where you would look at what are the hardware and electric costs of Bitcoin mining. And so that's kind of the idea of, just like it takes a certain amount of effort to get gold out of the ground, it takes a certain amount of effort to create Bitcoins. And so that also helps to derive a certain amount of value. And you've typically seen that sometimes the mining rates or the mining difficulty can then increase the price of Bitcoin, because it's becoming more difficult to create Bitcoin. Therefore, Bitcoins in a lot of people's minds are more rare, and there's less Bitcoin being generated every 10 minutes from those block rewards. You have utility value. So what's the value of the good or service potentially provided? In terms of Bitcoin, it can be, I can send it anywhere in the world and pay for the transaction fees. In terms of Ether, it's the resources, a commodity. And then in terms of tokens like Filecoin, it would be paying for storage fees or anything else that you would otherwise be paying something like Google or Dropbox for. Granted, it probably would be more expensive on Filecoin, but you would get some decentralized advantages. And over time, you might see that cost go down as the market becomes more accessible and more efficient. And then you also need to be very careful about what the issuance model is, because the way that coins are issued initially, as in how many coins are initially created, who gets them, as well as how the supply has grown over time, those are very important to understand, because that affects the entire supply dynamic. Ripple is, again, one of those projects that has a lot of controversy because there is a very large issuance still held by the Ripple team and protocol labs. And that's considered kind of unfair because it's such a highly valued cryptocurrency. There was no work involved to create them. It was just like, pop 100 billion Ripple exist. So there's a lot of questions about that. And other projects have the same issues. If the initial issuance wasn't done properly, there's a lot less trust that the project can be properly maintained, because it feels like a lot of people, it was people got an unfair advantage by getting so much at the start. And then a built-in supply cap is also good for ensuring scarcity. So Bitcoin will never have more than 21 billion created. Litecoin will never have more than 84 billion. Having a supply cap is a good way to say that this is going to remain scarce over time, regardless of what happens. And here are some additional operating valuations that is, how does a protocol operate? We just talked about like more of the fundamentals. This is more of like, okay, network health, for example. Is the network secure against attack? How is it operating? So these, I would say, operating valuation methods can change over time more. It's something you have to pay attention to see how a protocol is holding up. It's something you would, it would be like comparing the operating profits of a company or the just the business success of it over time. So this is what you would look at for a protocol potentially. So for network health, that's, Bitcoin mining rates. Are you secure against attack? Can you prevent a 51% attack? If you're becoming more centralized, if there's not a large group of miners, then a 51% attack becomes more likely. And there have been 51% attacks against smaller protocols. Ethereum Classic has suffered a couple in the last few years. Others, like Aurora coin, I remember, was actually an airdrop to Icelandic citizens. It suffered an attack because there weren't enough miners. So you definitely want to see that the network is distributed enough to protect against that. And you also want to see that the nodes themselves are geographically distributed. So for example, looking at the node count for, let's see here. Yeah, so the node count for Bitcoin is that there's a lot of nodes located geographically throughout the world. A large concentration in the US and Europe, a little bit in China. And this isn't miners, by the way, this is just nodes. That's why you don't see as many in China. But more geographically distributed nodes are good, because it means that if a certain part of the world suffers some sort of infrastructure breakdown or loses access to the rest of the world, the network itself will still be able to operate quite well. So you want a good geographic distribution across any area where it's in service. Another one is the software development. Is the code base well maintained? And this is definitely one of those things I always like to check if I'm looking at a new project. I'm like, okay, what are they been doing? And this is the one you can really tell, like, who was serious in an ICO and who wasn't. Because you can look at some projects and like the GitHub, they were like, ever since the ICO went through, like their GitHub was sitting empty for like months. They didn't contribute any new code. They weren't working on anything. They weren't providing any updates to the community. If you want to see a well-maintained code base. So really seeing frequent updates is crucial to know that the project is going to be successful. Because even if it's an easy use case in terms of just payments or something like that, you still need to see that it's constantly improving and keeping up with other protocols out there. And another thing you want to see is there an open source community that's actively involved in development? So, and this sometimes depends on the project. Some projects can get away with having just a core team and no one else involved, but it's nice to have an open source community where a lot of different people from different backgrounds and different companies are contributing to the same protocol, because it means that you're not dependent on one group of people or one group of coders, and if they decided to stop work, the protocol would go down. If it's open source, it means there's a lot more accessibility for different people to jump in and participate in code development. And then another big one for anyone who's an investor is market liquidity. Is the coin listed on mainstream exchanges, and can you easily buy and sell large amounts of that market? This is especially important for institutional investors to know if it's a good thing to buy into. And it's actually one of the biggest limitations, I think, on crypto assets, just the fact that even some of the biggest markets might not be liquid enough for a big player like a pension fund to actually get involved. But we'll hopefully see that change over time. And then, of course, user adoption. Is the coin getting adoption for its intended use case? Are people using Bitcoin not just as a store of value, although that could be part of its use case, but you also want to see, is it being used for payments and things like that? Same thing for Ethereum. Are they using Ethereum to purchase smart contract computation? Are they using Filecoin to purchase file storage fee or file storage capacity? It's okay if it's a little bit investor driven. But you do want to see, especially the utility focused tokens, to actually get used for what they're supposed to. That's pretty paramount. So how much daily use does it see? And then are there market incentives to grow the value? So just because a token is useful doesn't mean it's necessarily going to grow in value over time. Let's say like if a token for trading at fees, maybe they don't have anywhere to go, or maybe they maybe there's an alternative, like, for paying exchange fees, maybe people can just use normal cryptocurrency to pay it instead of this special token. Maybe the token itself isn't going to become as valuable in that case because there's not a reason to use it. So make sure the market incentives are there if you're worried about the utility and the user adoption. And so I know I'm at time here, so I'll run through these last two slides. But one thing I do want to really emphasize where a lot of this potential is, like this is going to be, I think, incredible for the industry once this really takes off, is how we can tokenize existing financial assets to work on blockchains. And you can kind of call them crypto assets, but I don't see them as crypto assets necessarily. I think they're just crypto-backed assets in terms of the cryptography and the technology that we know is powerful, can then basically make other assets like stocks and bonds more easier to manage for individuals and reduce market intermediaries. We can use the same infrastructure that has supported Bitcoin and Ethereum in terms of doing payments and having decentralized exchanges. We could potentially use that for these financial products as well, and get a lot of potential advantages out of that. So some efforts underway are stock issuance. Overstock was one of the first companies to issue stock as a kind of a crypto asset or as something on a blockchain. You see real estate capital raises as a project. A lot of people are trying to create real estate projects backed by cryptocurrency funding. And then, kind of with governance and profit sharing models embedded into the protocols. You see municipal bond issuance is a big use case that I think Berkeley was working on a couple of years back. You see digitization of gold and other physical goods, people trying to create collectibles. And I remember there was, I'm trying to remember the name of them. There's a card issuer based in Italy, and I cannot remember the name of it. But they do most of the trading cards for the big sports players, and they've started to do blockchain projects where they will tie your, baseball card to a digital asset on a blockchain. And they see a lot of potential for that because of the ability for you to have a digital representation of that good and then use digital markets to trade it. And so overall, we see a lot of potential. And most importantly, we see a lot of transparency that can make financial markets safer with crypto assets. So there's a quote from the CTFC chairman during a speech to the Senate in 2019. And he remarked that the blockchain technology would have allowed for a far faster and better informed, calibrated regulatory intervention for the 2008 crisis. And the reason is because these financial products that led to the crisis were so nebulous and so complicated and all backed by paper that no one could actually get into a mortgage-backed security and see, like, what are the homes that are actually backing this? What is the state of these mortgages? So are people actually paying them? It was so nebulous and so difficult to navigate, and having that sort of a structure on a blockchain would have not only made the data far more accessible, but it would have allowed automation techniques and others to be able to watch those assets in real time and understand what was the true risk profile. So there's a lot of potential for financial assets to be tokenized and basically serve as an additional boost to portfolios along with just traditional crypto assets. So in conclusion, crypto assets are becoming increasingly popular as an alternative investment, even for traditional portfolios. Yesterday I had my 88-year-old grandfather give me a call, and he was asking if he could get into Bitcoin because he was hearing some friends that were like, it's something they're saving for retirement. And he's like, well, I might as well get into it as well. So that's a good hallmark. I was hoping for a third generation to be calling me up and asking how to get into cryptocurrency. I never would have expected that to happen, but it's kind of a sign of where we're at, where even the most conservative investors are at least taking a look because they know there's some potential. It's still a new field, lots of risk, lots of potential. And so if you're looking to educate yourself, if you're trying to get more understanding before you dive in, I highly recommend this book, Crypto Assets by Chris Bernesky and Jack Dotar. I based a lot of this talk on that book, and I highly recommend it for anyone trying to get into the space more. And another thing that we learned in this talk is the regulatory guidance needs to be better. We need to define better regulations that fit these crypto assets and the new business models that they introduce. And I think that's one thing where the Texas Blockchain Council can step in. At the state level, there's a lot that can be done, even as the federal authorities are trying to get their head around it. So Wyoming is famous for being very progressive in the space, and we're hoping that Texas is able to keep up. And so with these economic and market uncertainties that are present today, alternative assets have never been more important, and therefore crypto assets are especially important. So if you're a finance professional or you're just an investor, you need to understand crypto assets, at least from a basic level, and know that it has some potential to help your portfolio and help you manage your risk with uncorrelated returns. So that's the talk. That's all I have on crypto assets. And if you liked this, then stick around for next week. We're going to be talking more about smart contracts and their applications in financial technology, as well as many others. But smart contracts, I think, are really where you see how crypto assets and others can really be enhanced beyond just trading it and transactions. They can get into how, digital logic and automation can be done in a trustful manner. So that's it. You can RSVP here. What I will do is I'm going to take the link to this slide deck and post it into the chat, and then we can take some questions.
Thank you, Michael. Easy to follow. So are there any questions? Give you 10 seconds. And what's the topic of the next one? Oh, there it is, smart contracts and DApps.
Yep.
Okay, I think we're done. Thanks,
Awesome.
everyone.
Thanks for having me, guys.
2 weeks. Yep. Bye-bye, Michael.